I wanted to talk about a simple moving average strategy that works. Um, in one of my videos, I think was about creating a strategy, I talked about how I've tended to see people who trade the crossover moving average. They can't consistently win in the markets. They don't have a consistently winning strategy. And I've yet to see a consistently profitable trader who trades the crossover moving average. But if you're looking for a simple moving average strategy that actually works, you should check out, well, basically this video is for you. So it's using the 8 moving average. Let me just show you the indicator and the parameters I use. It's the 8 moving average and it's exponential. So the difference between exponential and the simple or the smooth is that it's quicker to adjust to price movements, right? It's more volatile in that any quick movement is quickly indicated um, by the indicator. So say if there's a fast movement up, it quickly shows you by moving up. So the smooth indicator tends to be a bit lagged and slower. That doesn't matter. But basically set your parameters to 8 period moving average, exponential moving average, um, and close, right? Apply it to the close and then okay, set it in black. Simple as that. First thing you want to do is look for an area of support, a major area of support. So say we were looking in hindsight and we wanted to first trade this section here, this opportunity right here. We would go back in time, setting our targets, right? Setting our major support level. So here's the major support area. As you can see, above there. As you can see, I marked as a major support in this area. So we marked this area out. Now let's see how we can get to this thing here. And here's where you want to be very careful, right? Here's where you want to be very careful. We've marked up the support area, right? These big candles here that shoot down are usually there to knock out a lot of traders' stop losses, and it's usually because of the spread. It's not the price. The price is usually respecting the support. So the price is above the support resistance, but the spread is the one that knocks your stop losses out. It will knock you out and then start to move up. So to avoid that, you want to enter when the price starts to move above the 8 average. On the 1 hour chart, stick to the 1 hour chart. It works well. So this is the support area marked out, and you want to start entering once the candle starts to move above the 8 average. So you enter right. You enter here, and then you set your stop loss all the way down here where they knock out some traders. So that's where you're sitting your stop loss after people have been knocked out. And if you want to, and this is the kind of state which is made by traders, where they probably have to buy it off. And so buy at this area, the trade is going, they just leave, they have because their strategy is working, and then all of a sudden price moves down against them. And I talk a lot about the divergence strategy and how you can enter after the stop hunts. So essentially you are entering after the stop hunt and price is moving above the 8 moving average. And basically you hold. Once you've entered, you put your stop loss down here after everyone's been knocked out. You hold as price is moving above the 8 moving average. You just keep holding and holding and holding and holding. You do nothing else. You just hold and hold and hold for the next couple of hours. And what you essentially do is once price shoots up like this, when it pulls back and it starts to shoot up, you move your stop loss to the low after the push pullback, right? So say you enter here, it's going up, it's going up, it's going up, it's going up. Price pulls back down. You don't move your stop loss yet. Price pushes up again, then you drag your stop loss to this area here so you can lock in your profits and you don't give profits back to the market. Price shoots up and then comes back here and then shoots up again. You move your stop loss up here. This is so you avoid going to sleep at night and your trade is up $100 and then you wake up and essentially it's now back to $2 because you've given markets the money back. And then what happens again? Price moves up, shoots down, pushes up again. You move your stop loss up again, lock in those profits so that if you are asleep at night, and usually these divergence trades happen at night when people are sleeping, and then you wake up and you haven't given back all the profits to the market maker. So that's one entry. Say we've traded, that's how we would enter one trade. Where's the next opportunity? We'd look for another opportunity here. Would have bought and then brought to break even and then been taken out, which is fine. And then here's another opportunity. Why it's important to follow the rules I've just said is because if you did follow and you went and you got in after the 8 moving average, you wouldn't have been stopped out by this. Now, if you're going to continually trade like most retail traders who just buy at support and then set a stop loss at 35 pip stop losses, you will continually get taken out. Look at that. Doesn't matter how many pips you would have put as your stop loss, everyone was knocked out here. So it's important for you to think differently and trade differently. Otherwise, you'll continually get stopped out. See, all those people who were like, yes, you do buy at support. That's very true. But you need a strategy that avoids the market maker's stop hands. That's the kind of strategy you need. So you would be buying above the 8 moving average and then setting your stop loss now up all the way down here. You just set it down there in case they try to do something funny, because sometimes they do try to go back down and then shoot up after they've knocked a second time. So they'll usually knock stop losses here and then start to go up, knock some more, and then go up again. So you would enter, price would shoot up, come back down, shoot up again. You would move your stop loss here, right? Shoots up, shoots up, shoots up, comes down, shoots up again. You would move your stop loss. And then you'd avoid giving back all this money, right? That's a second opportunity. And then last week's opportunity, if you had traded um, this strategy, with the same support that I just drew, this is the same area, I didn't change anything. Here's a pin bar, and we start to move above the 8 moving average. You would set your stop loss where I've put this arrow here at our support level here. And then you would just hold, 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 push back, pull back up again. You would move your stop loss to this area here, pulled back, pushed back up. You would move your stop loss here. Pulled back, pushed back up again, you would move your stop loss. And remember, you're putting your stop loss there so that you're locking in profits, so that you're not giving back money to the broker, right? Pull back down, and then the markets have closed. But essentially, we're saying that after it's pulled back here, we're expecting price to continually move up. And you just basically ride the trend until it's given up. And that's the whole point of the strategy. It's a beautiful strategy. It's simple to understand. It works. It avoids stop hunts, and it's easy. Let's see. Ignore all this madness here. So here was the support area here that I've drawn out here. Let me go to the 1 hour. So I've just left the 8 moving average. So say you had been looking for a buy opportunity on this area here, and you had set your support area here, right? This is clearly a support area, clearly a support area, clearly a support area, clearly a support area. Now, where the difference comes in with the consistently profitable trader is here. Here's the support area we've just drawn. Here are the stop hunts, and then every trade has been taken out. Stop hunts, stop hunts, stop hunts, and then price starts to move up. So retail traders are correct that price does go up at a support area, but usually most of them are taken out, and it doesn't matter how good your stop loss is. It could be 50 pips, you'd still be taken out. And if you bought before the weekend, um, usually there's a gap in the market, and then it doesn't matter how good your stop loss was, the broker will automatically jump your stop loss and then take you out, and then price starts to go up. So it's important to follow the rules I've been talking about. You place your support area here, you get in once price is above the 8 moving average, right? And then you set your stop loss where the stop hunting happened. That's where you set your stop loss. You don't enter at the support area here because you'll always get taken out. You want to enter after we've moved above the 8 moving average, and then your stop loss is where the stop hunting happened. Price starts to move up, moving up, pulls back, jumps up, and as it's moving, you're also moving your stop loss. So there's a reason why I said you wait for price to pull back and then go up and then you move your stop loss. You don't push your stop loss as price is going up, as it's moving up, because you don't know how far it will pull back. You want to wait for a pullback and then a push up, and then you move your stop loss. Um, and then things continued, and yeah, so simple as that. Not too complicated. That's a second example. Let's see if there's another example here. Yeah, but I think you get the point. So just to reiterate, we said you first mark out the major support and resistance area. You do not enter once price hits the support and resistance area. That's where all the stop hunting happens. There's a reason why brokers want retailers to trade support and resistance. And I've talked a bit about it, and it's the reason is because when the broker knows how retail traders are trading, then they know where to stop hunt. Essentially, their spreads or what stop hunts people, not the price. They can't manipulate the price, but the stop hunts using their spreads, they will manipulate all day and all night. So it's to their advantage that everyone is trading support and resistance. If everyone's trading support and resistance, then the broker knows where everyone's setting their stop losses, where everyone is entering. So you've set out your major support and resistance areas, right? You don't enter once price touches that area, because once price touches that area, the brokers are looking to make money. You enter once price is above the 8 moving average, right? And you set your stop loss where the manipulation has happened, right? So that would be here. Here's where you would set your stop loss, and you would be entering all the way up here. So you wouldn't have been stop hunted, right? And then you ride the trend. You just ride the trend. You don't trade against it. You just keep it going. And then you move your stop loss after the pullback and a push up, not when the price pulls down like this. And that's usually where traders lose a lot of money, because they start to get scared and they jump out. No, you wait for the pullback and then a huge push up, and then you lock in profits. If you're locking in profits, then you shouldn't be closing your trades, because if you close your trades as soon as they're in profits, you'll never make money. You want to make sure you take advantage of the entire trend, and it's a good way for you to sleep um, peacefully at night, knowing you're not giving back money into the markets. You're not scared to hold your trades for long periods of time. So that's a good trend trading strategy for you guys. I hope that helps.